Any baseball fans here?
Yeah.
How about any Giants fans here?
Yeah.
Well, I'm a huge Giants fan. What an incredible run they've had. How about any VC fans here? I'm a VC fan at least some of the time. Do you know what baseball hitters and VCs have in common?
Full batting average.
Okay, 30% success rate is considered good. So what I'm hoping today is, what I'm talking about is in that 30%. A few other questions before we get started. How many of you have performed in an athletic competition and realized you hadn't trained well enough? How many of you have gone on a job interview and realized you didn't prepare well enough? And how many of you have taken a test and realized you didn't study enough? Well, I've done all three, and it's not fun. So today we're going to talk about the risks of doing something before you're ready, especially with respect to product and market. So I'm Sean Jacobsohn, and I've been in the business cloud space for 15 years, and 13 years of it were in operating roles where I ran biz dev and or sales at 4 companies: Cornerstone On Demand, WageWorks, Elance, and Hightail. And most recently, I was at Emergence Capital and joined Norwest a few weeks ago. So now I'm going to have the panelists introduce themselves.
So I'm Justin Moore, and I'm the founder and CEO of Axient. Axient is a powerfully simple business recovery cloud that enables a company to keep its core systems and applications up and running at all times. I've started 2 companies. A third one sort of was never really successful. And I also am a big VC, and sometimes a venture partner at Comvest Ventures as well.
Awesome.
How you guys doing?
Oh,
That's good. I came in here from Toronto today. You're going to hear some oots and oots. So yeah, I'm Mark Organ, founder and CEO of Influitive. Influitive helps you mobilize your army of customer advocates to generate a lot more
referral leads, reference calls, case studies, videos, testimonials, social media buzz, all that kind of stuff you need to grow your company efficiently. Before that, I was founder and CEO of Eloqua. Eloqua was a marketing automation pioneer, founded in 2000, and eventually went public and got sold to Oracle Corporation for about $1 billion in last year. So excited to tell you my story today, and let's get cracking.
Great. Very lucky to have both of them here. I actually asked them both if they were interested. I thought one of them would say no, but they both said yes. So we're lucky we have to hear stories from both guys. So we're going to make this interactive. I wrote an article on product market fit a couple months ago. It's in VentureBeat if you want to take a look at it. But I wrote it because there's a tremendous amount of confusion in this industry about how to define product market fit. A lot of people think they've achieved it and spend a lot of money in sales and marketing before they're ready. I can think of one company, for example, that raised money at $100 million valuation, raised $10 million. They thought they had achieved product market fit, spent all the money in a year on sales and marketing, and were out of business within a year. And there's a lot of examples of that. And so I wanted to put a framework together that might be able to align people around how to define product market fit. And it's really designed mostly for SaaS companies, which is what my experience has been in, but you probably could learn a lot for other business models as well. So if everyone can take out a piece of paper and a pen, and I'd like everyone to score along. Add up all your scores in each of these 5 areas, and then total them up, and we'll tell you what that means for your business and some recommendations we have. And while we're going through each of these points, Justin and Mark will give you some sense of how they scored their company at the time that they raised their first venture round. I found that when people fill this out on their own, without a discussion like this, they give themselves the highest possible rating. Of course, you know, if you're the teacher and the student, you'll give yourself an A+ every time, but that's not necessarily going to be helpful for your business. And then we'll have some time for questions afterwards. So the first point is around diversity of customers. And the key point here is companies that you did not know before you started your firm. So this kind of reminds me of when I lived in LA. I moved to LA for Cornerstone On Demand, and the tech industry is big here. There it's all about the entertainment industry. And so people would create a movie, and they get all their friends to come see the movie premiere. It'd be standing room only, and they're like, wow, this movie is going to kill it. All my friends and family came to the movie. This is going to kill it across the world. And a lot of those movies never make it outside of LA. So it's the same kind of thing here. There's a lot of startups that have customers that are their friends, and they all try to raise money off of getting their friends as customers. But that doesn't necessarily mean that it's going to work outside of Silicon Valley. My rule of thumb is if it works in Des Moines, it probably works in Silicon Valley. But if it works in Silicon Valley, it probably doesn't work in Des Moines. So, Justin, how did you rate your company at the time you raised venture funding?
First, can everyone hear me in the back without the microphone?
You can use this.
Yes, good, okay. I was a 5 on this when we raised our first venture round, and largely because I didn't know that many people in the Valley. I started the company 7 years ago, so I was kind of mid-20s. Took longer than 4 years to not complete Stanford because I left and started a company and went back. And most of our customers were kind of small to medium-sized businesses. So we had about 120 customers. They were a variety of law firms and accounting firms and health professionals and other things. And acquired most of them, frankly, by cold calling them and getting references from one customer to another customer and attending kind of local events. So yeah, none of them were in our network.
Well, that's a benefit of being young and not having a big network.
Yeah, there was no network.
There were no friends to call.
There was no friends to call.
Yeah.
Right. Okay, let's try the mic
Again, okay, maybe hold it down here. So I'm going to tell you both about Eloqua and Influitive. Now, Eloqua is an interesting story because it was a bootstrapped company. We ran that company cash flow positive for 3.5 years before we raised venture money. A lot of that was because we were not able to raise venture money. We were a bunch of 20-somethings.
Bunch of 20-somethings who really didn't know all that much. So by the time we raised our first venture round at Eloqua, we already had a run rate of something like $300,000 a month, $300,000 or $400,000 a month. And so I would rate us a 5 at that point. We had a natural advantage becoming from Toronto. Well, Silicon Valley was a foreign place, so we're kind of forced to be kind of born global, and I think that was an advantage there. Now, interestingly, I'd say at Influitive, I'd rate about a 2 on this, and this is the advantage to being a serial entrepreneur. So for those of you that are working really hard to build your first company, there is a light at the end of the tunnel. If you are halfway successful this time, then you essentially can make up for the gap with a little bit of team experience. So I only had maybe 11 customers when we raised our Series A. About 4 of them were pilots, free pilots, you know, and the other ones were paying us not a lot. So it was maybe like 10K MRR when we raised our Series A at Influitive. Again, special case though. You get extra points if you've done it before.
Yeah. Great. Well, thanks, guys. So hopefully you guys are all scoring along. And the next one is around engagement. I think products like Salesforce.com are ones that score high in engagement from the beginning. Because salespeople spend 3, 4, 5 hours a day in the product, and if you pulled it out of their hands, it would cause major disruption in their business. So Justin,
Ooh,
Yeah.
a 1. Probably still a 1, actually. Yeah, so our product is such that users don't typically log into our product and platform. It's one of those things that is designed to ensure that businesses don't have loss of productivity or interruption to their applications when primaries go down. So in an ideal world, you'd never use our product, but when you have to, it's business saving or massive productivity and cost saving. So by design, our product is one that people don't log into, and it has lots of automation and intelligence built in, so it kind of works on its own. So we were a 1 then, and we're still a 1.
well, some business applications obviously are more like Salesforce. I would say in this case, imagine if you pulled it away from your customers. How disruptive would that be for their business? And if it would be really disruptive, then it'd probably be a 5.
It would be highly disruptive.
Yeah.
Yeah.
How about at the time, even at the time you raised venture funding?
Yeah, because businesses basically, our first customers were betting on us to protect their business over their incumbent solutions. So we were a very critical part of their IT infrastructure, where if they didn't have us, they would absolutely have to replace us right away with something else, or they would violate compliance, they would be unprotected, their business would be at risk. So yeah, from that perspective, it was always a 5.
Okay.
It was mission critical day 1.
Then I give you a 5.
Okay, I get a 5 then. I was like, I'm nervous about this one, man. I'm still a 1.
No, that's good. So I think this is a great survey, and the reason why is for the first time, I think someone has defined product market fit as a continuum as opposed to a discrete endpoint, right? Mark Andreessen says product market fit is when the product flies off the shelf. Well, that's kind of hard to define. So I think that's great to have it in terms of a continuum. However, I think this question is this one's the most questionable in terms of how well it actually ties to product market fit. I think you've just defined it better. It's not about how often they log in. It's about how mission critical it is to the success of the company. So I'd say both at Eloqua and Influitive, they're both category creators. We're trying to create, in Influitive's case, we're trying to create a market around advocate marketing, trying to build that demand. Did the same thing at Eloqua around automating demand gen. So we were lower on both of these. I would say that Eloqua, when we raised our Series A in 2005, which was 5 years in, we were a 3. Eventually became a 5. There are a number of companies where Eloqua was absolutely mission critical and they could not live without it, but it took a while for the market to build to that point. I would say that at Influitive, we're about a 1 or 2 on that. And that's because we're still very much building a vision behind this market. I do think within 5 years we'll be a 5.
Great. Third point, around churn. So I commonly hear companies say, hey, you know, I only have 4% of my churn. That's pretty good, right? Well, that's amazing how often I hear it. But
Seriously?
yes, I do hear it all the time. But then I said, well, that means that 50% of your customers are leaving you every year. So in the early days, you can continue to grow. But imagine once you get to 10 million in revenue, and if you're losing 50% of your customers every year, 50% of your revenue every year, just to do 10 million again, you got to sell 5 million that year. So eventually you'll have no way of growing. So a company that I worked at before, Cornerstone On Demand, who started selling at the enterprise, have done really well with this. They only have 5% annual churn, and that doesn't include any upsells. So I know a lot of companies can mask churn by saying, well, it's really, we don't have any churn when you factor an upsell and expansion. The challenge is that at some point in time, you won't be able to continue to upsell or increase price. And it doesn't really demonstrate the health of your business. So, you know, gross churn is really the number to use in this metric.
Yeah, it's funny you say that. We don't even measure net churn. I mean, we measure it, but it doesn't show up on our board summary financial packets because of what you just said. If your gross churn is controlled enough that you have, you know, in leading class, then you should have really good net churn, but you can mask churn problems with net churn. This is an interesting one. So this is one we actually struggled with quite a bit at Axient in the mid days, I would say. in the early days, we always measured churn. We were always aware when customers canceled. One of our values, central values, is customer first. So we were always very focused on making sure our customers are happy. And part of the way we measured that was whether customers renewed. But, so, from that perspective, using this strict definition, I'd probably give us a 2 or 3 in the early days. What I would say we missed, though, was the importance of looking at churn trends. Because as you said, in the early days, you could have low churn, or seemingly low churn, but as that number gets bigger and bigger, unless your new revenue far outpaces your churn rate, it starts to become a big problem. And when we were about 10, 15 million in revenue, we hit 30% churn. And it is really tough to keep your business growing. We were still growing, triple digits percentages, fairly high triple digit percentages. But it's very hard to keep your business growing when you're losing 30% of your customer base, especially when you have thousands of customers under your belt. And this is one where we were definitely not on top of as much as we should have been. Looking at the leading indicators, measuring churn on a weekly basis. We actually measure churn on a weekly basis now. And we look at where are we against a predictable linear curve within week for a quarter, the week against the quarter, and that quarter against where we expect to be within a year. And if we see anything that's off, we do a deep dive immediately on what's going on, is there anything that could be behind it, what's causing these churn issues, is it product, is it price, within product, what is it specifically? And we often find that there is a systemic issue that we weren't aware of that we then need to go tackle before it becomes a massive churn problem. And when you're running a SaaS business, when we hit that 30% churn, in that year we lost about, I'd say probably about $20 million in customer lifetime value, which when you start putting in those perspectives is a huge number, as opposed to just looking at it as 2% a month or 2.5% a month. We've started looking at what's the lifetime value of that churn. It's a critical one. And now we're at just about 14% churn, which for a year, per year, which for an SMB-focused company is considered best in class and above. Most are kind of 20, 25% per year, we're kind of 14% per year. But it's because we had this obsessive focus, and we had the obsessive focus because we got absolutely punished because we didn't pay enough attention early on, and it became the entire obsession of the company.
Yeah, that's great. I think lots of insights there. Of all the questions here, I think this is by far the most important. So hopefully that's one of the things you'll take away from this, is that I think the best predictor of product market fit is that your customers continue to renew with you. And I mean, I would add some to that actively advocate for you and help you get more customers, which I think is even a better metric than renewal. Right? We do renew a lot of accounts because we have no real effective competition at Intuitive. But only somebody who's super happy is going to advocate for you. So I would say that I came out of Bain to build Eloqua, which had a real discipline around loyalty and around advocacy. So I was pretty obsessed with this coming into Eloqua. So we were definitely 5 points, probably more than 5 points, I would say, at Eloqua when we raised our Series A. And even at Influitive, where a lot of my numbers are lower because we raised essentially a preemptive A round, an earlier A round, we were pretty close to a 5 here too. At Influitive, and now at our Series B, we're actually at 6% gross churn. So yeah, we manage every dollar like our life depended on it. That said, these numbers include customers that we fire. So one of the ways, paradoxically, to keep your churn rate down is when you have problem accounts that probably should never have been sold in the first place, that are dragging down the morale of your customer success team and preventing them from saving the accounts that are worth saving. You've got to let those guys go. And so my churn rates include the ones that we fire, or the ones that we've lost to bankruptcy, which were a lot in the 2001 to 2004 timeframe when building Eloqua. And the way that we fire customers is we just triple the price on them, and then they decide not to pay it.
One interesting thing to add to this, because I do think, I agree, I think this is one of the most important ones. If you're thinking about a SaaS business or any kind of renewals business, one of the big learning lessons in our analysis, and I think you mentioned Cornerstone, so known for exceptionally low churn, Then you have a company like Workday, which has both hypergrowth and extremely low churn, which is unheard of. Right? There are very few companies that have that. And someone actually did an interesting analysis. If you look at kind of a 10-year horizon, if you compare kind of a Cornerstone, which has solid growth but not hypergrowth, and really low churn, and you compare hypergrowth with okay to good churn, long-term, Cornerstone ends up being the better business model, because as you grow your business in the out years, your base represents such an enormous part of your revenue that your net new cannot possibly compare to your base revenue. And if you are keeping that base, there's that much less you have to put in the top that's new every year. And so you end up building a better business that will actually have better revenue growth long-term, even if the interim years it was a lower growth. And so people have asked me, well, knowing that, which would you take? If you had to pick between one of the two, would you take solid growth, like 30% to 50% growth, and kind of really low churn, or would you rather have like 150% growth and like mid to high churn? And I'm 100%, I'll take lower growth, lower churn, because low growth, low churn, when you've built enough of an installed base and a customer base, will mean a much better company long term.
Yeah, and we're talking about gross churn here, but because Cornerstone has such low gross churn, they're able to tack on a lot of other products and also increase price. Typically every year they've been increasing price 5 to 15%, and usually people don't say anything because they're happy about the product, and they've been able to sell additional products on top of it. So the net churn is just amazing. It's like 120%. The other thing to keep in mind is contract length and size of customer you're going after. So I'll give you an example. In the early days, I know we look at Salesforce as a hugely successful company, worth like $35 billion, but they almost went out of business in the early days. They signed month-to-month deals, and they had extraordinarily high churn, so more than 50% a year. And new guy came in running sales and basically told their sales reps, we'll double your commission if you sign annual deals. They never signed a month-to-month deal again after that. So it's really how you pay people. And the other way to think about it is, one reason there's a lot of churn with SMBs is the fact that they're SMBs, and if you go after the real low end of the market, they're going to churn just because they go out of business or change priorities. So you got to be careful that you're not going after a market that's going to churn irregardless of how well your product might be serving their needs. So here's the fourth of 5 around commitment level. So there's certain very crowded spaces out there, and I probably won't mention some of them because maybe some of you guys are in those spaces. But where I meet a bunch of entrepreneurs in those spaces, and they all have the same customer logos on their slides. And then I call the company and I say, so I see you're using 12 products, and they're like, yeah, we're testing them out, and next year we'll decide which one we're going to commit to. So they're all trying to raise funding on the idea that they have a customer, but none of them are getting much money, and no one's got a longer-term commitment. So, as an investor, I want to try to figure out who is the winner in the space, and that doesn't really help. So, my rule of thumb, even in the earliest days, if you're going after a Fortune 500 company, they should be paying you at least 6 figures a year. Like I have one company came to me recently and said, we have GE as a customer. And I'm like, well, so how much are they paying? Well, they have 2 employees using it, they're paying us $5,000. That doesn't really, you shouldn't have earned the right to put GE's logo on your customer page. So if you're going after Fortune 500, it's got to be at least $100K a year, even in the earliest days, because that's really not that much money for them if they're really committed to your product. Going after a mid-market customer, it should be 5 figures annually, and if you're going after SMB customer, at least 4 figures annually. If it's not a meaningful check size for the customer, then they're not really that committed to your product.
I was laughing when you said people putting logos on slides, because I've had probably 5 VCs call me in the past 6 to 9 months going, hey, heard you're a customer of XYZ company. How are you liking their product? And I'm like, we are? I go, I don't know, I'll get back to you. And I go to the CFO, hey, are we paying for some product called XYZ? Nope. Send it to support. Finally, I find out there's like one individual in the company in support who like signed up for a free trial. And I'm like, yeah, we're not really using the product, so. But anyway, on this one, interesting. So add some color to what you said earlier, and then I'll share some of our experiences. So you mentioned Salesforce, and one of the things you mentioned was the annual contracts. But there's something that goes along with that you were kind of referring to when you were talking about size of customer, which was Salesforce's early customers were also very small.
Yes.
And if you look at how they've marched up the revenue over time, what you see is that in most successful SaaS companies, they tend to march the monthly recurring revenue or annual recurring revenue or ACV, whatever you use as your measurement, up over time, because the cost of sale relative to the revenue, relative to the churn. And it's those three things: Salesforce, NetSuite, HubSpot. I mean, you can literally go through all the companies. You look at their early customers, then you look at their customers when they go public, and then you look at the customers kind of 3-5 years after they've gone public. They all march up the MRR. They all march the size of customer. The churn goes down. Why? I mean, NetSuite, as an example, had over 30% churn in the early days. I think it was almost 40%, but it was really high. Huge churn, but their average customer size was $1,000 a year. So, you know, when you're selling to a small customer, you're going to have huge business mortality, tend to be more price sensitive. It tends to be less embedded because it's a smaller install. Therefore, it's easier to replace. And now NetSuite's average customer is 80 grand a year, plus professional services. That's just in their services. And so we found the same thing. So our average customer, when we started the company, was about $1,000 a year. Now, our customers, I'd say we were probably at 3 or 4. And again, slightly different because we waited to raise funding, just like you did with Eloqua, until we were doing, you know, we weren't at your MRR levels, but, you know, we were in the $300,000, $400,000 or $500,000 a year before we raised any venture funding or any capital. So we kind of built it ourselves and kind of funded it ourselves. And so we had to get customers. And we were typically signing either month-to-month or annual. There's not a lot of benefit to us getting pilots because our goal wasn't to go raise a round. Our goal was to first build a company. And then at some point we realized that if we got outside funding, we could grow the company more quickly. But our goal was always to build a company, and therefore we had to have revenue, so we charged for it. So I'd say we're about a 3. But one of the things we've become keenly aware of is our average customer size then was $1,000 a year. Our average customer size today is about $6,000 a year. The churn is still higher than we like, and the cost of customer acquisition is higher than we like. So we now have a new mandate internally, which is our average customer target is $20,000+ a year. We are trying to focus more on mid-market and get to $20,000 to $30,000 a year customers. That focus really started this year, and we've signed customers that are as much as $250,000 a year, even $500,000 a year now. And what we're finding is that the cost of customer acquisition is not that much more. It's more, but it's not close to as much as the 4 or 5x we're seeing in terms of average deal size. The churn is inherently lower. The stickiness is higher because they're embedding our platform as part of a huge part of their IT environment, and it's harder to replace it. So we have certainly learned that lesson on our own and then gone back and done the research on every other SaaS company, gone, oh, okay, it's the same thing everyone else figured out already. But we learned it the hard way. And so I'd say we were probably a 3. And we are actually looking at, we have annual contracts only, but people can pay month to month. We're actually looking at doing only annual pay as one change from a cash management perspective. And we are actually trying to incentivize both our channel and our reps to sign 3+ year contracts. And we have a rule now, whenever there's meaningful discounting over 20%, it must be a 3+ year contract. Because then we can look at the 20%, we can look at what it should theoretically do to our churn, and we can justify that discount if we know that we'll keep the customer for sure for 3 years.
And what's interesting about what Justin is doing, they started with very small businesses and they've moved their way up. I found about 80% of SaaS companies start small and move their way up. The only way you can't move your way up is if there's already a credible upmarket player that blocks you.
Yeah,
Mark.
no, that's great. So at Eloqua, the first customer that we ever won, we started at $3,000 a month. I don't know why I picked such a high number, but it was, I mean, that turned up being fortuitous. After that first customer, we want to try to win more customers. We actually needed to lower our price in order to win some other customers that we were talking to. That was taking us nowhere fast. So to your point, we saw our cash pile start to dwindle. It became very clear that we weren't going to raise any money. So I was lucky that I had a great mentor who basically taught me exactly what you just said, which is, okay, if you want to be a cash flow positive, self-sustaining company and not require any venture capital in your business, here's what you should do. You should triple your prices. You should charge for everything, including your prospect's own needs analysis, which we did. You want to build it, you want to see a demo of the product, you've got to pay for a demo environment. I'm not kidding. And do hyper focus on a niche, so that we became so knowledgeable about a couple of key areas of software that we sold into that prospects are willing to pay for our expertise. And we got the company profitable actually pretty quick, and stayed profitable for 3.5 years. So again, that's a kind of bootstrapped environment. So at Influitive, I said, hey, there's all this.
So how did you score yourself at the time
so
of
I
venture
have
funding?
5 for sure. I mean, all of our deals were at least a year. I don't think that highly of a 3-year deal because frankly, I mean, again, I've lived through a tough time, 2001 to 2004. A lot of people stopped paying their bills. So they can sign up with a 3-year deal. If they're not going to pay you 3 years up front, I don't think it counts. Because, a contract, I mean, what are you going to do? You going to sick a collections agency after these people? That doesn't really work that well. It just gives you a bad reputation in the industry. So I don't really think that highly necessarily of a 3-year contract unless they pay you up front, or unless it's a 3-year deal with an annual component that's paid up front. I really like those deals. Those are great. But at Influitive, we want to try something different. And like freemium was all the rage, and my fellow national compatriots at Hootsuite was building an enormous business on freemium. We're like, let's go try that, right? That's a great way to build a fast business. And what we learned was that, yes, we had a bunch of free trials, but the customers weren't that committed. And so what we did is we figured out what the price was so that the customer would actually be committed and not put an intern on the product, but put a director level person on it. And it turns out that price is approximately $8,000 for 3 months. So our goal was to get as many committed logos as possible. I think there's a continuum when you're building a company now, free pilot to paid pilot to 12-month contract with 3-month out to 12-month contract with no out to 12-month contract all paid up front. And I think as you march closer to that 12 months all paid up front, you're getting closer and closer to product market fit. So I'd say at Influitive, again, in a sense, we substituted team experience for some of that product market fit. Our Series A investors made a bet that me and my team would be able to close the gap. So we would only have been maybe a 3 or 3.5 out of 5 when we raised that Influitive.
Okay, great. And so the final point is around word of mouth and virality. So in one of my favorite companies here in the early days, an emergence capital company, Civitas Learning. So they sell software to higher education. And they found a product that was really mission critical, and since that community talks to each other quite a bit, before they even talk to a prospective customer, those prospective customers had already talked to at least 3 of their customers. So that's what can happen when you're focused on an industry where people share with their friends the industry standard solution they're using. And that word of mouth can really spread, and then you earn the right to sell more and more products to them on top of it.
We were definitely one. It was all outbound, cold calling, networking, trying to get referrals from people we knew. I mean, it was just hard trench warfare for every single customer in the early days. Again, I go back to, didn't have a network, had no money, and so you couldn't really afford a ton of online marketing. I mean, we literally would look at a role, we got a lawyer as a customer, and then we figured out, okay, well, where's a database of 100 lawyers in the area? And then we would call them and say, who deals with this issue in your business, protecting your data? Great. Well, we're working with companies like, XYZ, who's our only legal customer in the area. And we built our business that way. So it was there was no viral marketing, there was no inbounds at all.
Yeah, and this is one, again, I don't think the correlation is as strong between this question of product market fit. If you're a category creator, you gotta do some outbound, and CEO networking is gonna happen. Honestly, is any company gonna really buy your solution just because they like you and go for a beer? I don't think that happens anymore. I don't know. I still think that a company's gonna acquire a product if they really believe in it, not because of a relationship with CEO or whatnot. But so I would say that Eloqua was 3 points on this, where there was customer referrals, but there was an awful lot of outbound going on, and having to build up that brand of ours. And I'd say Influitive also only because we committed to inbound marketing much earlier in our life, and wanted to make that. We really wanted to make the whole inbound freemium thing work, because Eloqua was such a heavy lifting, outside Salesforce, big outbound lead gen effort. I wanted to try to build a more lightweight model. So I would say we're 3 here for Influitive as well.
I think you make a point which is true. One of the ways to look at this question, it really depends on your market. So if you're conducive to line of business, individual sale, you're probably going to get more, and it's something people are actively looking for. You'll probably get more virality, and then this question probably works better. I think when you're category creating or trying to take a new market, another way to look at it is how many people are actually looking for a solution. If you're and they may be looking for it in a traditional way, and can you hijack that research that people are doing, and have you figured out how to start being part of the conversation early on? And we were very unsavvy when we started this company about all these things. So, we didn't know about how to be part of the conversation. And frankly, even in 6 years, it's become much easier to be part of the conversation with LinkedIn, with a whole variety of other things.
You got to rewrite this question. It's wrong. I'm sorry, it's wrong. I would look more at cycle times, right? When you send a cold email, how long, how many people click through on that? How long is your cycle between initial conversation between like an SDR or an AE and a prospect? How fast do we move that to second meeting? How fast do we go and get a contract? Once we get the contract done, how fast do we get them up to speed? How fast do we get paid, right? So when I was at Eloqua, again, we were bootstrapped. I was maniacally obsessed with these cycle times because literally our life depended on it, right? If we didn't do those, so we were always looking for where the bottleneck is, get the whole company focused on those things. So that's what I would look at and say, how long is your sales cycle? How long is your time to value? So Eloqua, we looked at time to measurable value. How do we shorten that? How do you get it so that you can launch the customer in 2 weeks instead of a month, and then a week instead of 2 weeks? And then how do you launch them in hours? And that to me is actually correlated to product market fit, I think, more than this stuff. This is my thing.
Yeah, I think it also probably depends if you are creating a category or not. Yeah. Certainly if you're creating a category, it's impossible to start at a 5. Because it's possible you may have created a category where there's not enough demand. If you are joining an already existing category, you might have a much better product, and now you can just displace the market. And so yeah, there's a lot of ways to measure this, and but anyway.
Sorry.
How did you guys?
It's not totally wrong.
Yeah.
The intent of the question, though, is an important one. In one of your earlier questions, it was really about once someone's deployed this and they're using it, would taking it away from them negatively impact their business? And another way to look at that, so that's once you are in the business. Another way to look at that is on the front end, as they are looking at making a purchasing decision, is there enough pain around, are you solving enough pain that they're actively interested in using your solution in one of two ways? Solving a pain, removing a negative, or solving a pain in terms of an efficiency where they can gain better productivity. And there are different ways to measure that, but it's super important to measure that, because if you're trying to convince people that they need what you have, that's a much harder market to crack than people who either identified a pain where like, God, this hurts, I want to remove this, or gee, I'd like to grow faster, right? Which is kind of the flip side. And I think it's always better to be in the productivity curve. We're sort of, but not really. Is can you help people grow their business faster? And people are always looking for ways to get an edge over their competitors. If you fit into one of those two categories and you can measure it through email responsiveness or SDRs, or people looking for more traditional solutions that solve that pain, it's super, super important, because I can't tell you how many companies I've looked at, CEOs I've advised, where I'm like, I just don't think people have enough pain around the solution to really have a company. Like, you're going to convince people they need what you have when they don't think they need it. That's hard. That's really hard.
Yeah.
So hopefully everyone scored along the way here. So how many of you scored 0 to 9 points? Thanks for being honest. How about 10 to 17?
That's one of my companies, 10 to 17.
And 18 to 25.
And the other one is
And how did you guys score when you first raised your venture rounds again?
yeah, so Eloqua was a 23 and Influitive was a 50.
I think I was somewhere around 18, 19. I was 5 and a couple, and then you're generous on one where I rated myself a 1 and gave me a 5. So I suppose I get up to like 19.
I pushed you to the next category.
Yeah, exactly. I would have been 10 to 17 otherwise,
Yeah.
but I guess I'm like 19.
So here is some of my thoughts around go-to-market. Certainly when you're in the 0 to 9 category, the founder should be the head of sales. You shouldn't be out there trying to find someone. You're still trying to figure out if you have product market fit. And the early customers are going to want to know that you're committed to their business success, and you have the sense for the problem you're trying to solve more than anyone else. Salespeople are coin operated, and if they don't have some reference accounts to leverage, they're going to leave pretty quickly. So, once you're starting to see that you may be in product market fit mode, in the 10 to 17 category, it might be worth hiring a couple sales reps. And I say 2 sales reps because if both perform really well, then probably you're onto something, and maybe it's time to hire 2 or hire more. If one is performing well and one's not, then it's probably performance related. If they're both not performing well, then you probably aren't a product market fit yet, and you might need to retrench. You guys have any thoughts around?
I'd add one clarification to this as you're thinking about this. So I could read this and go, hey, I'm a 20, 21. It's time to invest in go-to-market to accelerate. I'm going to go hire 10 salespeople and blow it out of the water. And I've seen a lot of companies do that, and I've done that. And then I had to riff half the sales force, which was awful. So one caveat on this, which is there's a big difference between product market fit and I have figured out a repeatable sales model and go-to-market strategy. Because 1, the CEO and founder can be a phenomenal salesperson. And 2, you can find those early people, those early types of salespeople who are just awesome startup salespeople. They're scrappy, they're undisciplined, they're not metrics oriented, they don't spend their time in Salesforce. They just figure out how to get it done in a different way for every deal. And if you scored yourself like a 21 and you had 2 people like that, which again, I'm repeating like history from my own life experience. So then we went, we're like, okay, we got a venture round, now we got 3 people, we're great on all this stuff. And so we hired like 10 sales reps, and we went up to like 13 people, and all of a sudden, we're doing kind of double the amount of new monthly recurring revenue with 5 times the sales force. So our sales efficiency just like fell off a cliff for 6 months. And we were at the board, we're like, this is not working. So we basically had to riff more than half the sales people and retrench and now focus on, look, we've got product market fit, people like it, but our sales model does not scale. We need to reassess the scalable sales model And that was a big learning lesson for me because I've been very disciplined since then about looking at each step of the way as I incrementally hire more salespeople. Are we maintaining that scalability? And as soon as we have those checkpoints, we hire more and hire more and hire more. But that was an expensive learning lesson, probably $1 million learning lesson when you think about the impact of churn on morale, riffs on morale, and the hiring and firing and retraining and all this kind of stuff. And I've seen tons of companies make that mistake. So that's my caveat to this slide.
Yeah, I agree. You need to have a repeatable sales model that then you can leverage for the next set of salespeople. I do see that problem. A lot of times you don't even know what the right profile of sales rep you want to hire. So you need to get the early successes before you know what profile you need.
Yeah, I got a similar story on that. So way before my Series A at Eloqua, I did raise a seed round, and I got real excited, and I did go and hire 3 journeyman type reps. So those are reps that are not the cowboys, they're not artists. They are actually the types that you should hire later, that know how to follow a process. That's actually not what you want to hire in early days. You do want, frankly, artists who have no problem lying through their teeth, actually, in the very early days. But one thing I was really, really lucky is that one of my angel investors happened to be a sales trainer in his past life. And so what he counseled, he came in to see what was going on, and he counseled right away. He says, you fire these people now. He put me through his sales training program, taught me how to sell, and said, you're going to get out there and you're going to go and close deals yourself. And frankly, God, that guy is amazing. He saved my company, right? Because from that point on, I was going out there. I'm certainly not the best salesman in the world, but I was able to really listen and learn and figure out what it took to get our product sold. Then I hired more entrepreneurial types, kind of like me, and those people actually did quite well for a while. And then eventually we got to the point where we did bring in a VP of sales, probably too late. I probably waited a year too late to bring in a VP of sales. That guy had to fire all my sales reps and then hire journeymen who could follow a process. Jason Lepkin has some great blog posts, by the way, on this. And also, I've had an interview. If you do a search on my name for Mark and cowboy sales rep or something like that, you'll find a really good interview where I talk about how to actually build a sales force in the beginning and then the middle and then the end. But yeah, very painful lessons, I think, for both of us on this one. And then probably every entrepreneur. Right?
Yeah. And you were head of sales at Influitive for a pretty long time.
Yeah, for a long time.
Like how far did you get into revenue?
So 2 years in, and then I only hired 1 rep, and then I didn't hire 2, I hired 1, but I worked, essentially I was the other rep. It was me and the other rep, so it was kind of a pair. And it was us 2 for 2 years. And that's not just for sales, it's because that's, and this other person is very entrepreneurial. In fact, he just left my company to start his own company. That is the mark of a great rep number 1 or number 2, is they're actually entrepreneurial and they won't be with you forever. But the 2 of us were going often as, as a pair and learning from one another and this sort of thing. And so you're not just being a sales rep number 1 is not just a salesperson, they're also almost a mini product manager, right? They're listening for trends and they're trying, they're A/B testing different messages and they're seeing what works, right? They're feeding all that back into the engineering team. And it really wasn't until as soon as we got won our 10th customer, that's when we started to say, okay, we hired sales rep number 2 and then 3 and 4 in very rapid succession.